why this crisis is nothing like 2008, and that's the problem. Everyone keeps asking the same question: is this another 2008? But that question is already the problem, because this crisis doesn't look like 2008 at all, and that's exactly why it's more dangerous. To understand what's really breaking, we need to stop comparing charts and start comparing incentives. Why everyone keeps expecting another 2008? For almost 2 years now, one question has dominated every conversation about housing. Is this another 2008? You hear it in headlines, you see it in comment sections, you hear it from friends, coworkers, even people who don't follow housing at all. Prices are high, rates are high, affordability is collapsing. So the conclusion feels obvious: this has to end the same way. But that instinct, as natural as it feels, is exactly what's misleading people right now. Because when markets break, they almost never break the same way twice. The reason 2008 still looms so large isn't just because it was severe, it's because it was traumatic. It burned a pattern into collective memory: loose lending, bad loans, foreclosures, price collapse. And once the brain learns that pattern, it looks for it everywhere. Anytime prices feel stretched, anytime buyers disappear, anytime something feels unsustainable, the mind fills in the rest. But here's the uncomfortable truth. Most people aren't analyzing housing today. They're replaying 2008 in their heads and waiting for the same ending. That's not analysis. That's pattern recognition without context.
In 2008, the system broke fast and violently. It was loud, it was obvious, and once it started, it couldn't be stopped. So people assume that's how all housing crises must look: a sharp drop, a wave of forced selling, a visible reset. But what if the next crisis doesn't come from people being unable to pay? What if it comes from people being unwilling to move? What if the market doesn't collapse, but instead slowly stops functioning? Because here's what rarely gets talked about. 2008 trained us to look for crashes. It didn't train us to recognize freezes. And freezes don't create panic. They create paralysis. Transactions dry up. Mobility disappears. Entire generations get locked out, not by defaults, but by math. Nothing looks broken on the surface. Prices don't crash. Banks don't fail. There's no dramatic moment where everyone realizes it's over. And that's precisely why it's harder to see. So before we ask whether this looks like 2008, we need to ask a more important question. What actually broke in 2008, and what's breaking now? Because once you understand that difference, you'll see why this crisis isn't just different, it may be harder to escape.
What actually broke in 2008? To understand why this crisis is nothing like 2008, we first need to be precise about what actually failed back then. Because 2008 wasn't caused by high prices, it wasn't caused by overbuilding, and it wasn't caused by people being priced out. It was caused by credit collapsing from the inside. In the years leading up to 2008, housing demand wasn't real demand, it was borrowed demand. Mortgages were being approved without verifying income. Down payments were minimal or non-existent. Adjustable rate loans reset higher after just a few years, and lenders assumed that rising prices would cover every risk. The system worked only as long as prices kept going up. The moment prices flattened, the math broke. Borrowers couldn't refinance, payments jumped, defaults accelerated, and once foreclosures began, they created a feedback loop. More forced selling pushed prices lower. Lower prices trapped more borrowers underwater, and underwater borrowers had no incentive or ability to keep paying. That's how a housing correction turns into a housing collapse. But here's the key point most people forget. In 2008, supply exploded. Not because builders suddenly built too much, but because millions of homes were forced onto the market all at once. Foreclosures, short sales, bank-owned inventory. Homes didn't enter the market because people wanted to sell. They entered because people had no choice. That flood of supply is what crushed prices.
And it's exactly the ingredient that's missing today. Today's homeowners aren't over-leveraged with risky loans. They're locked into fixed-rate mortgages, many below 4%. They didn't buy with teaser rates or negative amortization. They bought with long-term financing that got cheaper in real terms as inflation rose. In 2008, the average mortgage rate on outstanding loans was rising. Today, it's effectively frozen. That one difference changes everything, because when payments are stable and affordable, defaults don't spike. And without forced selling, supply doesn't surge. So when people say, "This feels just like 2008, what they're really saying is that prices feel uncomfortable. But discomfort alone doesn't break a housing market. Structure does. And structurally, this market is built to resist collapse, even if that resistance creates a different kind of damage, a slower one, a quieter one, and one that's much harder to fix. In the next chapter, we'll look at what happens when a housing market can't fall and why that outcome may be worse than a crash for everyone trying to get in.
A market that can't release supply. In 2008, supply flooded the market because homeowners were forced out. Today, supply is missing because homeowners are locked in. And that single difference explains why this crisis feels strange, slow, and deeply frustrating. Over the past decade, tens of millions of Americans refinanced into historically low fixed-rate mortgages. Large portions of existing homeowners are sitting on rates below 4%. Many are below 3%. That rate isn't just a number, it's an anchor. Selling a home today doesn't just mean giving up a property. It means giving up a financial asset that may never exist again. For a homeowner with a 3% mortgage, moving at today's rates can double their monthly payment, even if they buy a similarly priced home. So they don't move. Not because they don't want to, but because the math doesn't allow it. This is the lock-in effect, and it's freezing the market from the inside. Normally, life events generate housing supply. People move for jobs. They upsize, downsize, relocate, or retire. That's how homes change hands. But when mortgage rates spike, those normal life transitions get delayed or canceled. A couple stays in a starter home longer than planned. A family postpones upgrading. A retiree decides not to downsize. Each individual decision makes sense, but collectively they drain supply from the system. And here's where the comparison to 2008 completely breaks down.
In 2008, prices fell because inventory surged. Today, inventory stays low even as affordability collapses. Because sellers aren't under pressure, they're protected. Protected by fixed payments. Protected by rising nominal incomes, protected by inflation eroding the real value of their debt. So while buyers wait for prices to fall, sellers simply wait them out. No panic, no urgency, no forced liquidation. And that creates a standoff. Buyers can't afford to enter. Sellers won't give up their position. Builders can't fill the gap fast enough. The result isn't a crash, it's stagnation. Transaction volume drops, mobility declines, markets become thin and distorted. Prices don't fall meaningfully, but access disappears. And this is where the crisis becomes less visible but more damaging, because housing stops functioning as a ladder. It stops being a place people move through over time and starts becoming something people get locked into or locked out of. That's why this doesn't feel like 2008. There's no explosion, no release valve, just pressure building inside a system that can't move.
In the next chapter, we'll look at who this hurts the most and why the damage compounds quietly year after year.
Who pays the price for a frozen market? When housing stops moving, the damage doesn't hit everyone equally. There is no single shock, no universal pain. Instead, the costs are distributed unevenly, and that unevenness grows over time. Some people are shielded, others are quietly pushed further out. Homeowners who bought before interest rates surged sit on the protected side of the system. Their monthly payments are fixed, their housing costs are predictable, and in real terms, inflation works in their favor, making yesterday's debt cheaper every year. They don't need prices to rise to benefit, they just need the market to stay frozen.
But for everyone else, especially first-time buyers, the system works in reverse. They're not just facing higher prices, they're facing a moving target. Rates rise, monthly payments jump, inventory stays tight, and every month they wait, the gap between income and entry cost widens. This is no longer about timing the market. It's about being structurally excluded from it. And the consequences extend far beyond housing. Because housing is not just a place to live, it's the foundation of mobility. In a healthy market, people move toward opportunity. Jobs expand, wages adjust, housing responds. But when housing is locked in place, labor mobility begins to collapse. People stay in cities they've outgrown because selling would mean giving up a low-rate mortgage. They turn down higher-paying jobs in other regions because housing costs erase the wage gain. They build their lives around preserving a mortgage instead of pursuing opportunity. That friction rarely makes headlines, but it quietly slows productivity, dampens wage growth, and reduces economic dynamism. Then there's the generational divide. Older homeowners are not winning because they made smarter decisions. They're winning because they entered the market before access tightened. Younger households are not losing because they're reckless or impatient. They're losing because entry costs have become disconnected from income growth. This system doesn't reward productivity. It rewards timing. And that's a dangerous shift. Because once housing turns into a closed club, trust in the system erodes. People stop believing that effort leads to stability. They delay forming households. They delay having children. They delay putting down roots. Over time, they disengage. And this isn't theoretical. Household formation slows. Birth rates decline. Regional inequality deepens. All without a single dramatic collapse. But here's the part most housing discussions overlook. A frozen market doesn't just harm demand, it also suppresses future supply. Builders don't respond to price signals alone, they respond to turnover. When existing homeowners don't sell, transaction volume falls. Lower volume increases risk. Financing becomes harder to secure. Projects are delayed, downsized, or canceled altogether. So the very stability that protects current owners also slows the production of new housing. And over time, the system becomes self-reinforcing. Low supply keeps prices elevated. High prices reinforce lock-in. Lock-in reduces turnover. Reduced turnover discourages new supply. That's not a cycle, that's a trap. And it's why this crisis is fundamentally harder to solve than 2008. Because there's no single point of failure to target, no market crash that clears excess, no bailout that resets incentives, just the slow narrowing of who gets to participate and who doesn't. And once exclusion becomes structural, fixing it requires far more than patience. In the next chapter, we'll examine why traditional policy tools struggle to break this dynamic, and why many well-intentioned solutions risk locking the system even further in place. Why the usual solutions don't work. When housing affordability collapses, the instinct is to intervene. Lower rates, extend loan terms, offer incentives, subsidize demand. On the surface, these ideas sound reasonable. They're familiar. They're politically attractive. But most of them share the same flaw. They treat housing like a pricing problem when it's really a mobility and supply problem. Take interest rates. Lower rates don't magically create more homes. They simply allow buyers to borrow more. And when supply is constrained, that extra borrowing power gets absorbed into prices. That's exactly what happened during the ultra-low rate years. Affordability didn't improve, it got worse. Prices surged faster than incomes, and the market pulled future demand forward. Now consider extended mortgages, 40 years, 50 years, or beyond. They don't reduce the cost of housing, they just stretch the payment. And when monthly payments become the only thing that matters, prices adjust upward again. The buyer feels relief, the system doesn't, because the lock-in effect remains. Existing homeowners still won't sell. Inventory stays tight. Mobility stays frozen. So the policy adds leverage without unlocking supply. That's not a solution, that's a delay. Then there are subsidies, down payment assistance, first-time buyer credits, targeted incentives. These programs help some individuals, but they don't scale. In tight markets, subsidies become bidding fuel. They help buyers compete against each other, not against the shortage. And often, the benefit flows straight to sellers through higher prices. The uncomfortable reality is this: there is no easy fix that preserves current price levels, protects locked-in owners, and restores affordability at the same time. Something has to give. Either prices adjust, or mobility is restored, or access continues to deteriorate. And most policy avoids that trade-off, because confronting it means admitting that housing has become more than shelter. It's become a financial system. And once a society builds wealth, retirement, and stability on rising home values, change becomes politically painful. That's why solutions gravitate toward optics instead of outcomes. They keep prices elevated, they keep owners comfortable, and they quietly accept that new entrants will wait longer or never enter at all. In the final chapter, we'll step back and ask the hardest question of all. If this crisis doesn't end in a crash, what does resolution actually look like, and who will it be built for? What resolution actually looks like. When people talk about fixing the housing market, they usually imagine a single moment, a crash, a reset, a return to something that feels normal again. That mental model comes directly from 2008. Back then, the system broke loudly. Prices collapsed, credit froze, and the damage was impossible to ignore. And because the pain was sudden and visible, the response was also sudden and visible. But that expectation is exactly what makes today's crisis harder to recognize and harder to solve. Because this time, the system isn't breaking, it's ossifying. And there's a critical difference between a market that collapses and a market that stops moving. A collapsing market forces decisions. A frozen market delays them. And delayed decisions quietly reshape society. In a housing system that no longer clears, prices don't need to fall for access to disappear. They only need to rise faster than incomes, year after year after year. That gap compounds, not just financially, but behaviorally. People delay household formation. They delay having children. They delay career moves that require relocation. Eventually, they stop planning around ownership at all. Home ownership shifts from a milestone to an exception, from something you work toward to something you inherit into. And that's when the housing market stops functioning as housing. It becomes a sorting mechanism. Those who already own gain stability and leverage. Those who don't are locked into permanent flexibility, moving when rents rise, adjusting life plans around leases instead of equity. This isn't a crash scenario, it's a stratification scenario. And once stratification sets in, it becomes self-reinforcing. because elevated home values aren't just numbers on a chart, they're embedded into everything. Local government budgets rely on property taxes. Household balance sheets rely on home equity. Retirement plans assume rising values. Entire regions become dependent on housing staying expensive. At that point, affordability isn't just inconvenient, it's politically dangerous. Lower prices don't just help buyers, they threaten existing owners, municipal revenue, and perceived wealth. So the system adapts, not by fixing supply at scale, not by restoring affordability, but by stretching the timeline. Longer mortgages, smaller homes, higher household leverage normalized as just the way it is. These aren't solutions, they're pressure valves. They allow the system to continue functioning without actually resolving the underlying imbalance.
And the longer this goes on, the harder resolution becomes. Because resolution would require something no one wants to openly admit. It would require restoring mobility, homes changing hands again, people moving for opportunity, not avoiding it, housing behaving like infrastructure, not a speculative asset class. That means more supply where demand actually exists. It means zoning reform that reduces friction instead of preserving scarcity. It means accepting that prices cannot permanently outrun wages without consequences. But here's the uncomfortable truth. Restoring mobility means someone gives something up. It means existing owners give up guaranteed appreciation. It means municipalities give up easy tax growth. It means investors accept lower returns. And until there's a consensus on who absorbs that cost, the system will default to the least disruptive path: stagnation. Not dramatic enough to trigger reform, not painful enough to force action, just slowly narrowing access year after year. That's why comparing this moment to 2008 misses the point. 2008 was a shock to the system. This is a slow constriction, a market that still works, just not for newcomers, a system that still functions, just not for mobility. And grinding systems don't break overnight. They wear people down quietly. If you're waiting for a crash to reset housing affordability, you may be waiting for something that never arrives. But that doesn't mean the crisis isn't real. It means it's unfolding in a way that's harder to see, harder to measure, and much harder to reverse. And that's why this crisis, precisely because it looks stable, may end up being more consequential than 2008 ever was. If you've made it this far, thanks for watching. This series isn't about predicting a crash. It's about understanding a system that looks stable on the surface, but behaves very differently underneath. In the next video, we'll look at why many traditional policy tools, rate cuts, subsidies, and incentives struggle to fix a frozen housing market, and how some of them may actually make the problem worse. If this analysis helped clarify what's really happening, consider subscribing. Not for hot takes, not for headlines, but for clear, data-driven breakdowns of how the U.S. economy is actually functioning right now. You can also leave a comment with the part of the housing market you want us to examine next: affordability, supply, demographics, or policy trade-offs. Thanks again for watching, and I'll see you in the next chapter.